Our interest rate is going down. On September 17th, 2025, the Federal Open Market Committee lowered its target range by 25 basis points to 4.00 to 4.25%, the Fed's first cut since late 2024. But what does that really mean for the economy, for markets, and for you? What is the normal interest rate? The long-term average. If you look at the federal funds rate across decades, a reasonable long-run normal for the policy rate is roughly 4% to 6%. Meaning today's range sits near historical normal, but far above the zero-rate era of 2009 to 2021 that many remember. Immediately after the Fed cut, Treasury yields actually rose a little. The 10-year clocked about approximately 4.0% because Powell's remarks sounded cautious and markets digested what gradual easing means. Rate futures moved to price a high chance of another cut in October and more easing through the rest of the year. Now the million-dollar question: what should the Fed's policy rate be right now? My view weighs 5 facts. 1. Growth is softening. Retail and manufacturing signs are mixed. Rail freight is modest but positive. People are still buying, but not booming. 2. Labor market is cooling. Job gains have slowed and unemployment has edged up, increasing downside risk to employment. 3. Inflation is sticky. Core inflation remains above the Fed's 2% target, so cutting too quickly risks reigniting price pressures. 4. Geopolitics and tariffs. Renewed tariff risks raise input cost uncertainty and could slow trade, arguing for caution. 5. Technology, AI investment. AI-related capex and corporate demand support parts of the economy, but it's concentrated and uneven. Balancing those, the Fed's recent cuts to 4.00 to 4.25% looks slightly restrictive to neutral. If inflation continues to drift toward 2% and labor softens, a neutral near-neutral stance in the approximately 3.0 to 3.5% range would make sense as a longer-run normal. But given inflation is still sticky, the Fed is justified to move slowly. So, I think a neutral policy rate today would be around 3.25%. But because inflation isn't yet tamed, the Fed's cautious 4.00 to 4.25% is understandable as a temporary holding position. Should the Fed cut interest rate again this year? Short answer, yes, probably one more cut is likely. Not because inflation is solved, but because the Fed's dot plot and market futures are both signaling more easing in 2025. The Fed's own projections indicated room for further gradual cuts this year, and futures lifted odds of an October cut after the September decision. Looking into 2026, it depends. Many banks and strategists, e.g. Nomura, forecast additional cuts through 2026 if inflation steadily decelerates and growth weakens. Some even model a path back toward approximately 3% by mid-2026. That's plausible, but conditional. If inflation stays sticky or re-accelerates, cuts could be delayed or shallow. I'd assign a moderate probability to further easing in 2026, especially if labor weakens and inflation keeps falling. But it isn't a sure thing. The Fed remains cautious on upside inflation risk. Market signals. Rate futures and bond markets are pricing multiple cuts through late 2025 and into 2026. Markets pushed probabilities of an October cut quite high after the September move. At the same time, the yield curve is only slightly positive now, 10-year minus 3-month near flat, which tells us markets are torn between slower growth and eventual easing. Finally, the Fed will act slowly and data-dependently. Expect more cuts priced in by markets, but remember, the Fed is trying to thread a narrow needle between cooling inflation and avoiding a hard landing. Subscribe. I'll see you in the next one.